Alrighty, everybody, welcome aboard. Today is January the 2nd. This is Marcidi here, and we are going to do a What Do You See? Let's talk about marking up the charts. Let me explain my chart layout first. In the center is my main chart here. On the left, top left, I have this is a Heikin Ashi, and I'll talk more about that later. And then this panel on the left over here, central left, is a 30-minute regular candle. And down here is just a watch list. Okay. Now, I'm going to pick starting at 7 a.m. Eastern Time right here. Now, what the indicators are on the chart, this is a Bollinger Band. Now, a Bollinger Band is the middle of the Bollinger Band is a 20-period moving average. That's the white line. The lines above and below it are 2 standard deviations away. Now, in theory, this will capture 95% of all the price action. 95% of all price action should be between those 2 lines. And the Bollinger Band strategy, which I'll talk a little bit about today here, but that's not 100% of the focus today. The focus is what do you see in the chart, and we're going to talk a little bit about the market maker move also, which I may go ahead and jump to that first. But anyway, I'm just explaining my charts right now. The Bollinger Band strategy is a reversion to mean or a ping pong idea between the 2 outer bands. We'll combine that with RSI, some different things. Let's jump in first of all since we did have a request about the market maker move. Let me get my zoom key up here. Now, Signet talks a lot about this market maker move. We are looking at the SPX, and it shows a market maker move of 27.9. The market maker move is derived by a formula kind of thing of what the market makers are seeing as opposed to the options. Now notice here, let me go back over here. I am looking at today's 0-day option. And of course, time-wise, we are a little bit after 11 a.m., so we've only got 5 hours left in the day, 5-6 hours. But the implied volatility right here is a formula also on plus or minus. Now this, obviously, this is a dollar figure. But it's now to the left, you can see it's a percentage. But the dollar figure makes the most sense to people. And so implied volatility is based on the options of what they expect the bounds plus, we'll call it $29 up, plus $29 down. And they say it should stay within that range. From where we are now to up $29 to down $29. Those are the bounds. So if we are currently at 38 or 68.35, so just say plus $30. So they're saying it should stay between 68.65 and 68.05. The market maker move, however, is implied volatility plus other things like news events or, other external factors. It is a derived figure. And in general, the question has always been, well, do you add market maker move to implied volatility? And the answer is no, we do not. We generally take the higher of the two. We take the higher of the two and we go with that. So let me point out, I'm going to collapse this option chain here. We've got the 0, we've got the 3-day, which will be Monday, Tuesday, Wednesday, Thursday, Friday. If we go over here, back over to the option chain, you'll notice 28 plus, move of $28. Then we see a move of $46. And this 21% is oddball. That's really oddball. I think maybe because we've got a short week or something. $60.72. This is normal. This is perfectly normal. This is a smaller number. This is the next one. Quit. There. The next one's a slightly bigger number. Slightly bigger. Slightly bigger. This is normal, and we call this contango, which means that everything's lined up as it should be. If, however, that a number here in a closer expiration is bigger than the next expiration date out, let's say this was 50 and this one was 46, we call that backwardation, which means that the market is expecting more violence today than Monday. And that's when you see that kind of situation as a humongous red flag. Humongous red flag. And it will also be factored into the market maker move. But generally speaking, they are derived from the market maker move versus implied volatility are derived from two different places. Part of this, implied volatility, is supposed to sort of kind of be a 30-day forward-looking metric. But it gets really confusing because you're like, well, but this is a 0-day expiration. Yeah, I know. It gets confusing. Generally speaking, look for the two and take the bigger one. That's generally what I would tell you to do, is go with the bigger one. Let's see. All right. Any questions on that, do let me know. And I hope that helps a little bit there. But they are calculated differently, but they do share certain of the same common metrics in their formula. They're just a little bit different. Renata, yes, this is being recorded locally, and then I'll upload it afterwards. Okay. Understanding how to read the chart is very important for day trading, swing trading, all kinds of stuff. Remember, trading is fractal. What's the word fractal mean here? Fractal means that you'll see the same patterns, the same concepts on just about all different time frames. We see here a head and shoulders. You know what? Let me get my Epic pen thing up so I can draw on this screen. Give me a moment here. But while this is happening here, here is the left shoulder. Well, come on. Do what you're going to do. Hurry up. Do, 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 do. Well, whatever. I guess it worked. I don't know. Well, dadgummit, come on. There it is. All right. Let's get this drawing tool going here. Here is the left shoulder. Here is the head. Here is the right shoulder. This is the neckline. Well, that wasn't straight at all, but it's this line right here. And the idea being that if we break above this line, golly, if I could draw a straight line, it would really help today. let's back some of that out and let's go to a, yeah, let's try this. So we start the left shoulder right here. After that left shoulder forms, we look at this high right here, and I'm going to come across and I'm going to look for a break of that line. And sometimes the right shoulder's the higher one. That's fine. If that's the case, we'll use that one. But whichever one of these are called the neck lines. So you have a shoulder, you have a neck, you have the head, a neck, and a shoulder. If it breaks that, we would be saying then that we would be looking for a measured move. And let's see, I need to go back to this. Now these are nuggets. This is not a, whoops, that's not what I wanted. F8. Here. Well, lock in. Come on, there you go. So I'm going from the head to the neck. And the measured move basically went usually, this one kind of failed, but generally speaking, you should expect it to make like a 50% measured move. Failed a little bit there. Didn't quite make it. But the idea here is that you look at this candle right here. This one closed outside. Then we look at the next candle. If it continues north, we would take the trade long. Stop being right back here at the neck. And we could take this trade long, looking for the 50%, maybe 100%. This one actually did start, but then it failed. So in this one, you know, if we were actually doing it true to form, we probably would have maybe broke even if we'd have moved our stop up when we saw it turning around. We could have gotten out of this trade here because when we saw it, if it came back down, then I don't know the order. Maybe it came down first and then went up. Maybe it went up and then came down. I don't know. But at any rate, when we see this candle here, we might say, you know, we got a fair value gap right here, small, but there is a fair value gap. Fair value gap, for those of you that don't know, you see this wick on this candle right here. You see this wick on this candle right here. So we'll call this candle number 1, candle number 2, candle number 3. A fair value gap, and when there is no touching, no overlap between candle number 1 and candle number 3. Right? Price has a tendency to come back and fill this little gap, as it did right here. It hit the gap, but it continued moving on. At any rate, the point being is that this idea of this head and shoulders is visible on all time frames. And so you can see it here, you can see it on the hourly, you can see it on the 15, you can see it on the daily. Yes, Austin, this is being recorded. So, like I say, I'm just commenting about different things that we see in the charts here. Let me move this over here, get you out of the way. All right, now let's talk about marking up this chart. First thing, let's talk about trend lines. Understand that there's two kinds of moves by the institutions. One is a planned move. Planned moves occur based on news and based on market opening and closing. News and market timing. An institutional move, listen closely to what I'm about to say, because so many people get this wrong. An institutional move, let's see if I can find one first of all. Let me move back to the 15 minutes so I get a little bit more time here. Let's go back a couple days. What's this? Yep, here we go. No, that's a market open. Here. No, that's a market open. I'm looking for an 8:30 candle. Here. Right here. An institutional move is when, in this case here, we're talking about news. We're going to talk about news, then we'll talk about marketing, opening, and closing. The news itself has nothing to do with which way an institution is going to trade. The news is simply a time trigger. Unless the report, CPI, PPI, FOMCs, all that kind of stuff, unless the report is way outside of bounds of expectation, the institutional move is planned long before the report comes out. So if the news report is halfway within expectation, the institutional move is going to go whatever direction they wanted it to go. So if CPI comes in and it shows that inflation is dropping, you would think that's bullish. And yet, you may see the institutions have a huge sell-off or maybe a huge gain. It don't matter. It doesn't really matter because they have already planned out their move before the news event was released. Now remember, there's multiple institutions and they are all competitors to each other. So sometimes we see these violent moves down, violent moves up, back to the middles, all kinds of stuff. We do not know what the market is going to do when the news hits. It could fall off a cliff and it just head straight all the way down. It could strap on a rocket and go to the moon. When those things happen, it just happens to be that all the institutions, or the majority of the institutions, are all coincidentally trading the same direction. If the market just plummets and just keeps going down, it's because all the institutions just happen coincidentally to all be going short. Same thing if it straps on a rocket and it goes north. It's just coincidence. But the point is, we don't know in advance. It has nothing to do with the news other than the time that the news comes out. They all agree that they're going to make their move when the news breaks. Now, if all the institutions are scattered, some are long, some are short, and it's about equal money or whatever, then that's when you see it plummet, let's say, rocket, and then come right back to the middle, or something like that. The order that it happens simply is whose order hit first. Okay? So that's why we say when news is coming, stay the hell out of the trades. Get out of it. Because here's the other thing about it is, when these trades happen, they will run over your stop so fast. You could say, oh, I put my stop right here, and it went all the way down there before I got triggered and stopped out. Remember that a stop, here's a nugget, a stop is a point on a chart where your order becomes a market order. In other words, a stop is a place on the chart where you say, if price hits this, market me out of the trade. Now, why does that matter? Well, remember that market orders, there is a line, there's a queue. And when you trigger a stop, when a stop is triggered, and you convert to a market order to do something, get in, get out or whatever, you're in the back of the queue. You are in the back of the queue. It's like going to the license plate bureau. You go there and you're like, oh my God, there's 500 people in line. Oh, I don't know about where you guys are or not. Victoria, I don't know about you and stuff like that. I think, are you in here? Anyway. But in the U.S., a lot of these license plate bureaus you go to, and Lord help you if you're in a big city, you go there to, do something with your license plate, and you get there and you're like, there's 55,000 people in front of me. Oh my God. It's like going to a popular rock concert. If you don't get there long before they open. Anyway, when a stop is triggered, it converts you to a market order, and you're in the back of the line, which means everybody's getting filled before you that was already sitting there. So the worst thing you can do is to move your stop, especially because every time you move it, and same thing for a limit order. If you say, well, I'm going to set my take profit right here. You set your take profit right here, but then you think, I think it's going to take out these highs. I'm going to move my take profit up to here. Well, you just moved to the back of the line. Nothing's happened yet, but you moved yourself in the queue. When we talk about Bookmap and all that other kind of stuff, and we show all these resting orders, anytime you move your stop or your limit, you automatically went to the back of the queue. So don't move them unless you have to. So that's one thing to bear in mind. Any questions about that? And by the way, this is an open mic session. If anybody's got any questions, you're more than welcome to come in on chat or on voice. Okay. All right, so what do we see? Now, the other event, market open. I talked about institutionals. We don't know what's going to happen when the known news event comes out. Notice I said known news event. So when the known news event comes out, we don't know which way the institutions are going to trade. They really don't give a damn about the news unless it's way out of bounds. So that is a planned move for them. The other planned move they have is market open and market close. So many minutes, 5, 10, 15 minutes, who knows, before the market opens at 9:30 Eastern, institutions pile in their stock orders, buy or sell Tesla, Nvidia, AMD, Colgate, whatever. And they say, when the market opens, place these orders. And they're all piled up. So when the market first opens, all these orders hit the books at one time. Yes, Austin, they're being recorded. Well, yeah, okay. So when the market opens, all these institutionals orders hit the market at one time, and that's why we tell you stay away from the 9:30 to 9:35 time period. Because the institutions orders just hit the gates. And there's going to be a lot of volatility in that window. And again, we don't know if they're going long or going short or anything like that. So that 9:30 to 9:35 Eastern time, just sit back and watch. The same thing can be said, where are we? Wait, I'm looking down here at the bottom. Where am I? 1600. I'm looking for 1600. There it is. Okay. What? Oh, I didn't go back that far on this chart. Let's see. Let's go forward then. The same thing that happens in the last 5 minutes of market is the institutions place their end-of-day trades. And these are called a market on close, MOC. Now, a lot of times you may see on some of the different financial sites like Financial Juice or Thinkorswim or whatever, and they'll say MOC imbalance of 500 million to the sell side. Well, what does that mean? Well, that means that the institutions have issued, after you tally up all the institutional orders that are supposed to happen at 4 p.m. Eastern Time on the dot, that let's say it was $500 million to the sell side. Some, and this is the aggregating all of the New York Stock Exchange or the NASDAQ or whatever market they're talking about. And they're just simply saying that at the end of the day, the Merrill Lynch, Morgan Stanley, JP Morgan, whoever, simply said, at the end of the day, we want you to sell 5,000 shares of Tesla. Whatever price you get at the end of the day. And that's called a market on close. So you have a market on open and a market on close. So, all that being said here, we've got our news candles, known news, typically somewhere around 8:30, 9:30, 10 o'clock Eastern Time. These are known events. Stay out of the way. First 5 minutes the market opens, stay out of the way. Last 5 minutes the market is open, I would tell most people stay out of the way, because we don't know what's going to happen when all those orders hit the books. Okay, enough of that. I want to go to a 5-minute chart. Has anybody got any questions on that before we start marking up this chart? All right, let's see. I want to go to today, and we're going to start on the 5-minute chart. Let's stretch this out a little bit. Let's bring this over. Let's talk about what do we see. First thing, here, I see a high to a high. We've got me a trend line right there. Now, why that high? Well, if I go back, oops, I'm going the wrong way. Actually, you know what? Let's start over. Let me tighten this up a little bit more because I know that was hard to see. Let's back this up a little bit. Crunch it up a little bit because I want to see pre-market.
Hey,
Yeah.
I'm looking at your chart when you current time frame. I typed it out, but I figured
Oh, I'm
you
sorry.
were looking at the chart. I see a measured move, and correct me if I'm wrong. I see a bear flag forming, and couldn't a measured move lower estimate be done on it just to see
All
if
right,
it
let's
will?
talk about where you see that bear flag. I've moved my screen a
So
lot while you were talking, so.
yeah, yeah. So if you go to the current and kind of squish it together so we can see the whole, keep going. Yeah,
Okay.
there we go.
If I know what you're talking about right there.
Correct.
Okay.
And even before it,
All right.
above it.
Yeah. All right. So when we see, here's the pros and the cons to a bear flag. So first of all, for those of you joining, let's talk about what is a bear flag. A bear flag is the overall trend is down, and we have a temporary up move. That is a bear flag. What we expect to happen is a breakdown. That's what we're talking about right there. Now, the same thing can be said for a bull flag. When the overall trend is up, you have a little pullback, and then you expect it to break out and go north. All right? So, the way I would trade this, and whoops, still in the drawing tool, The challenge that we have with a bear flag, you've got multiple ways that you can trade this. Let me open this up. Number
The only
one.
reason why I'm asking is because um, Jeremy,
Uh-huh.
um, looking at his diet, it kind of taught me a lot in terms of how to do the measured move.
Mm-hmm.
And because I agree with you, the bear flag, it can fail a lot,
Sure.
right? So I was just saying, not it wouldn't necessarily work its way out, but it's wouldn't a an idea be to do an estimated measure move down
Okay.
to see if it meets it? That's
All
all
right.
I was saying.
Sure, sure. The problem with the way a lot of people were taught the bear flag is they look for the break. And what that means is not, they say, well, they draw this trend line. And they say if it closes below that, you take it south. The problem is they don't have a target. That's the way a lot of people were taught to do flags, was to draw that trend line and look for the break. And the only target you got is that low right there. It's the only target you got with the way people were traditionally taught. What I would do, now this is me, instead, I'm going to come back up here. This is a high that went into a fair value gap and took out a high. So we had a low, we had a pullback, we had a lower low. So I'm going to mark here for the top of my measured move. I'm going to mark down here for the bottom of my measured move. And that is the way I would mark the measured move. In this case, because we have this intermittent pullback. Now, what if you don't have that pullback? Well, then you've got to find a measured move. Now, there's multiple measured moves in here. Here's one. If I do that, I'm going to mark out this 111. This is going to be hard for you guys to see, but let me zoom that in so you guys can see that. I'm going to mark out this 111. I'm going to mark out this 123. And I'm going to mark out this 50. Okay.
I like that.
All right. Now, I'm going to get rid of this. The problem with all these Fibonacci things is it's just so much noise. Now, the other way to mark this out is we have I'm going to call it, it's not really a big ass candle, but it is a dominating candle right here. And I'm going to mark it also. Now let's look for confluence. We see that a 50% measured move of this red candle would take us down to here, which is pretty close to our 111. But there's nothing else that aligns with anything else. Now, of course, I've got Bollinger Bands on here, so we actually are seeing three different things right here. I've got a Bollinger Band. Right above it, I've got a pivot point, if you use that. I've got, multiple things that say, if we break south, this is my primary target, because I got three different things right there. I got a 50% move based on this big candle. I've got the measured move, and I've got a Bollinger Band. So I got three different things pointing right here. Now, so I'm looking, now the problem is, well, where do we break? Where, dadgummit, do we look for the break? Well, now I'm going to look at the context of the chart. I hear this, I talk about this, I scream about this all the time. You got to look at the context of the chart, because I'll tell you, I've said this a dozen times before, all strategies work sometimes. No strategy works all the time. It's in the context. Well, what is the context showing me? In this case, I've got Bollinger Bands on, and purple is VWAP. Well, what do we notice here? We notice at market open, this is market open around in here. We went up to the Bollinger Band, down, walked it down, pushed it down, came up to a white line, which is mid, walked it down, lower Bollinger Band. I would be looking for an entry short right around that white line with a stop slightly above. I mean, you can say your stop is right here because that's the high. And I usually give it about 3 ticks in case it runs up there, grabs liquidity, and rolls back over. But you could look for an entry right here because we see the pattern that it has stayed under that Bollinger Band midpoint. If it breaks above that Bollinger Band midpoint, where is it likely going? To the upper Bollinger Band. Well, we don't want to be in that trade. Not short, anyway. So, again, the problem with a lot of people in the whole idea of the flag is they get in. Now, I won't say that, I'm not going to say that breaking this is wrong. If you get in here and go short, that's not necessarily wrong. You've got a very tight stop up here. That's pretty good. The problem that most people have is they don't have a target. Now, if you decide to trade the traditional break the line method, your measured move is the top of the bearish channel flag to the bottom. Well, that's not a very big range. That's not a very big range. There's not a lot of money in this trade. Necessarily, because you just take a look at it. That's not what I wanted to do. I wanted to do that. Let's say it breaks right now. Well, that ain't much of a move. I mean, we've got some moves and stuff like that, but I've got a much better trade if I get in up here and go down here as opposed to getting in down here. Not to mention the fact I've probably got a better stop up here. And the thing of it is, now here's another place where people make mistakes. Here's a perfect example right here. This broke, you say, oh, it's breaking, but it didn't close. And you can see what happened. People will take the wick and they'll get in on the wick. You can do that, but as you can see, you would have been stopped out here. So here we see we're breaking that trend. But what do I see? Let me get rid of this fib. What I see is a small, tiny little liquidity right here at this candle. Notice it came down to it. And what's it doing? It's going back up. Trend lines are heavily noticed by the algos. Heavily noticed by the algos. So what we have here is a tug of war. Here's another snippet, or nugget, if you will. Watch the tug of war. Just watch this candle. What do we see happening here? They tried to push it down. They tried to break the trend line, but it's being rejected. Now, what this is an exhaustion of money. You've got institutions and retail traders fighting over this position, and the question is, who runs out of money and throws in the towel? Somebody's going to run out of money. If the buyers run out of money, we plummet. If the sellers run out of money, we head back up. Do you know which way it's going to play out? No. I don't want to be in this trade. I don't know what's going to happen. Now, when this candle closes, if we break lower, that'd be different. But right now, look at the tug of war. Just watch it. Now, this is a 5-minute candle here, so we're not going to sit here the entire 5 minutes and watch it. But this is the idea that I'm trying to convey to you. Every candle has a story as it evolves, and we want to watch it. Again, who's running out of money? Okay, the buyers right now have run out of money. So if I were trading this candle kind of thing, again, well, see, buyers are stepping back up. Again, it's a tug of war on this candle. This is why this is not a good candle to trade, because we don't know who's going to win this war yet. Better to wait for it to get up to a known point. It could be here, if you're doing Bollinger Bands. It could be here where liquidity exists. It could be the purple line, which is VWAP. And I'm not sure what this line is. Let me back out and see what that is. Okay. This is a GEX line. Comes from Menthor Q, like Spot Gamma. This is one of those option lines where they say there's a lot of options activity, kind of a lot of heavy options at 6,900. So it's a reactionary line. So maybe. Okay. So I've got multiple places where I could get in my short if I really wanted to. It just depends on what your strategy is. And it doesn't matter. They all work sometimes. Be consistent with your strategy, manage your stops, manage your risk, stuff like that. But okay, so this candle is still messing around down here. We'll have to watch and see what happens. Renata, does that help?
Yes, it does. It
Okay.
does. I like it.
Good, good, good. All right. What else do we see in this chart? Now, let's talk about trend lines and derived trend lines. This is a weird concept for a lot of people, and you've got to fish around and find it. I'm going to fish around. A trend line is 2 points. Here, top of this candle, to the top of this candle. Does that work for me? And why do I stop here instead of here? I would only select this one if this candle, or if we ultimately set a lower low. But right now it's in a pullback. That's not a valid target. It has to be this one. Now, a trend line is on 2 points make a trend line, but at that moment it's a weak trend line. Not very strong. Look over here. Talked about this a moment ago. Is that going to break that low? It did break the lower low. You could take the short here. Notice this trend line, though, that we drew from back up there. Does that mean we're going to start walking this line down? And what does this candle right here tell me about this trend line? I have a third point. The more points that end on a trend line, the stronger it is. 2 points on a trend line, weak. 3, a little bit stronger. 4, more strong. 5, stronger yet, and so on. This candle ended, or did it? No, it didn't. Actually, it stopped a little bit high of it. But it depends also on how accurate I drew the trend line. This is one of the problems that you have with softwares like Tradovate. Now, I love trading on Tradovate, but it's got one major flaw. And that is, if you draw a trend line, let's say on the 5-minute, if it's diagonal now. Horizontals are fine, but anything diagonal, and then you turn around and you go to a different time frame like the 1 minute, it's broke. That trend line will not be in the same place. For whatever reason, Tradovate cannot carry a trend line over into a different time period. It's weird, it's strange, but that's just the way it is. Which is why I'm using NinjaTrader. This is not a plug, it's just me. NinjaTrader is Tradovate with a more professional charting platform. It uses your Tradovate account. All right, it uses your Tradovate account and all your settings and everything that you have in Tradovate, like if you have daily loss limit locks and if you've got at the money strategies for your trades, all that kind of stuff in Tradovate carries over into NinjaTrader. But NinjaTrader bought Tradovate a couple years ago, or a year or so too, whatever, and so you do not need to create an account on NinjaTrader. You log in with your Tradovate account, and so I'm on my Tradovate account with a professional level charting platform that works. And you can also write scripts, and NinjaTrader's been around for 1,000 years, so there's all kinds of scripts and everything out there for it. Any rate, enough of that. I'm on the 1 minute, and notice this 1 minute walking this trend line that we set way back here. And in fact, I'm off just a little bit. Let's see if I can tune this to right there. Here to, if I really want to be anal about it, no, it would go there. And what do we see? Came up to the trend line, rejected. Came up, now look at this pattern. Came up, broke through, came back down, bounced off the trend line, went up into this fair value gap again, but it was already settled here. In this case here, we see it hit the Bollinger Band, came back down, but now it's walking the top of this trend line instead of the bottom. This trend line is validated now. I had to go to a smaller time frame to see it, but it's validated. Now, that being the case, let me show you what the derived is. I'm going to scrunch this up. I know this chart's getting busy, so just pay attention to these gray lines. I'm going to click on this trend line, copy and paste. Now, this is the derived trend line. What I'm looking for is some place where this trend line is going to make sense. And let's try there. Actually, let me go to the 5. I need a little bit more room. Stick with me a moment while I work this out. There. Right there. Notice right here, right here. Amazing, perfectly same angle parallel channel. Absolutely amazing, isn't it? I hope I just blew your mind with that one. This is my original trend line. Here's my derived one. A lot of times I will mark the derived one. Now the question is which one's more accurate. I think this one's actually more accurate. So I'm going to make this one the derived one. And what I mean by derived is not to the tick, in the area, not to the tick. And I'm going to make that a dash because it's derived. So actually this is the trend line. This is the derived line because you can see it did break it, it's walking in and so forth. There's your channel right there. Look at that. Did y'all catch that? We were taught trend lines, but nobody ever taught us about the parallel trend line. Some people talk about, well, yes, we can derive a channel here. Now, what does that tell you? Well, that tells me, you say, well, yeah, okay, but so what now? This is a short. Very possibly a short. Now, and remember we got those marks down here? Right here, here. Look at there. We have S2, a pivot point. we have, well, no, that trend, following that trend line would take us back down here to the Menthor Q 1-day minimum. That's a long trade. That is much, much longer trade, obviously. You can see the bear flag is failing here. We marked this measured move. This was one of our targets. Here's another target. We marked from here to here, and that derived the second and third target. First target.
But it's not failing. It's the bear flag isn't failing. It's actually following through, right?
Yeah, okay, good point. Breaking. Excuse me, let's go with breaking, not failing. Poor choice of words, my fault. You're right. Breaking. So my first target, we had confluence right about here. Of course, this Bollinger Band has turned up some. We are hitting a pivot point here, and we have some liquidity right here. So we took liquidity from this candle. We came down to the pivot point. We're down at the Bollinger Band. This is a potential Bollinger Band strategy would say this is a look for a long out of this. If this break continues, here's our target right here. Maybe this one for a runner. But right now we've hit the Bollinger Band. So I've got multiple strategies going here. You've got to pick the one that makes the most sense to you and how long you want to be in the trade. From a Bollinger Band standpoint, I'm out. From a measured move, I'm holding out for this one right here. But it's entirely possible that it will go back up before it rolls back down and comes down to here. From a channel standpoint, I got a long way to go. A long way to go. This is the rest of the day trade. If I think we're going to get down to this S2 down here and stay within this channel, well, I don't know, 1240, following this line down and looking at the time, here's 1 o'clock Eastern, so it's an hour from now, possibly, if it stays within that channel. So we got multiple strategies here. We've talked about a break of a bear flag. We've talked about a Bollinger Band. We've talked about measured moves. We've talked about the tug of war in a candle. So many different things going on here. Now, again, I'm not saying that you need to know every single one of these. I'm saying you need to identify the strategy that makes the most sense to you. I am not trading all of these at one time. Absolutely not. I see them. Doesn't necessarily mean I'm trading them. Just because I see them does not mean I'm trading them. I may take them into account. But I would have one trading strategy. In this case here, I like Bollinger Band, so I would have probably traded this on the Bollinger Band, but at the same time, I would not have gotten into this trade except for somewhere back here. I would have gotten in this trade back here because we were near the midpoint of the Bollinger Bands, ridden it down. I would have probably gotten out here, maybe here, left a runner, and right at this point here, I might have a runner still going. On the other hand, if I want to trade the measured move, this is my target right here. That's the 111. This is the 123, and this is the 50. So if I'm trading the measured move, I'm still in this trade. My entry would have been somewhere around in here. Not a perfect entry, though. I may not have even gotten into this entry because we never actually tagged the midpoint. So, there's multiple ways you can look at this. There's multiple ways you can look at this. Or if you could say, if you're a purist, then if you didn't get into this trade back here on the Bollinger Bands, you would have gotten in here, and that's the only place you would have gone short. And that would have been at 10 o'clock this morning. because it tagged the upper band. And if we look over here at the 30, we were talking about 10 o'clock, so let me blow this chart up. Here's the 30 minute. Here is 10 o'clock. Right here. Now, would I have taken this trade? Yeah, maybe. Here's the problem. Upward slope. Upward slope would tell me better to go long, possibly there, but kind of flat at the same time, so maybe, maybe not. That one's in question. So let's talk about higher time frames for a minute. We have short-term scalping. Now, a scalp could be 30 seconds, 5 minutes. Long-term trading, though, you have day trades, which would mean that, you know, you could be in a trade for an hour. My trades this morning took over an hour, which is unusual, but it's, you know, a holiday week. There's not much institutional move going on here. The only thing mostly running here are the algos, the institutional algos, and they're just nickel and diming. They're just nickel and diming and nudging the market in a direction that they want it to go for whatever reason. Could be they're pushing it down so that Monday they can take it to the moon. They can really get in at a low position and rock it to the moon. And they're slowly pushing it down so that people don't panic, people don't panic, people don't panic. I don't know that's what's going to happen. I'm just, you know, speculating. But that's possible what happens. But see, we're walking this trend line. And that's the derived trend line. Actually, we realized later, this is the trend line. This one's derived, but we're walking it right now. What do you know? Multiple strategies at work here, multiple different ways to look at it. You have to pick the one that makes the most sense to you. Now, if you're an ICT trader, I know this whole mess is getting all clustered, but if you're an ICT trader, watch. Here's that high right here. Here's that low right here. Here's 50% retrace right here. Here's the fair value gap right there. There's the rollover down. Perfect ICT setup. Absolutely perfect ICT setup. Absolutely perfect. This whole idea of a high that takes out a bunch of highs before it and a low that takes out a bunch of lows before it with a fair value gap in the middle, and of course my stupid RoboVac just went off, so if it comes over here I'll turn it off. So we have a fair value gap that's above the 50% point, midpoint. We come in, we get into that, we go short. We look to take out at least this low, maybe lower. We can use the measured move. There's yet another strategy. Right? So you say, well, wait a minute though. How would I know if this ICT is the right move to take today? Because I've seen it go up, down, and go all the way back up again. Good point. All right, the setup. A high, a low, a fair value gap, and that's called the market maker. That's called the market shift. Creates that fair value gap. We traded up into that fair value gap. But what do we have here? We had a Bollinger Band midpoint, and we had VWAP. That's your reversal point. That's where that's using multiple things. Could you trade this chart totally blind? No indicators. Sure, you would get in here when you came into the fair value gap. However, your stop has to be back here because you have to give it the option to move through the entire fair value gap, which it could do. In pure ICT trading, you have to give it the entire fair value gap to chop around in before it makes its move south. So the downside to this here, by having like at least VWAP on here, I know that VWAP is there, so I know that I could set a tighter stop instead of having to put my stops way back here. I could put them a little tighter. But also, some people would say, well, you need to dig into about half of the fair value gap. Well, but I've got VWAP on here, and that's a turning point in a lot of cases. Yeah, it'll overshoot it a lot of times, or it'll come close to it, and it'll dance around it sometimes. But that would be the point you would go short. Okay? So again, there's another one, another strategy, ICT setup. So we've got measured moves, we've got bear flags, we've got ICTs, we've talked about the candle. Now, what else can we talk about on this? Let's talk about pivot points. Pivot points go back to the Stone Ages. Pivot points came out back in the, 70s, 80s, whatever, something like that, back when floor traders, we had a lot of floor traders because we didn't have a lot of computers in the time, as far as personal computers. And the institutional traders on the floor needed to agree on magic numbers that they all agreed upon. And so they created what were called pivot points. Back of the napkin math here. The pivot point is the prior day's open, high, and close, averaged together. That's this number. Open, high, low, close, I think it is. Yeah, I think it's all four of them. And whatever that is, that's this number right there. Whatever the prior day was, that's this number. And then there's some math of, half of the prior day plus the pivot point or something like that is this number. And then you got is the resistance and the supports and all this other kind of crazy math stuff. You can Google it. Obviously, these numbers make no sense today. There's no reason for these numbers to make any sense today, but people still trade them. People still trade them. Remembering that trading is psychological, day trading is psychological, there's no reason for any of this to happen except psychological and taking people's money. What was the purpose of this trade right here? What was the purpose of this trade right here? Was to stop these people out. Because we see this big bearish candle, a lot of people went short here. All this did here was stop them out so they could turn around and go short using their contracts instead of having to take new contracts. That's just, just fighting. But beyond that, this overall why are we bearish trend today? It's all psychological. And so you'll find that many of these trades, just like Bollinger Bands, 95% of all the price action is between this red band and this green band. Why is that psychological? What people expect. They like the calm, steady predictability of this better than they do letting a chart just be wild and crazy all over the place. So Bollinger Bands work. It's a strategy. Not the best. Nope. It's simply a strategy. But talking about the pivot points, look what happened right here at support 1. Right there. Right here. Bouncing off of it. Resistance 1 up here. I know you can't see it very well. It's in this red dotted line. Up, came up to the Bollinger Band, but it's in this area here. Let's go back to pre-market. My mouse is staying in the same place. See how we chopped all over that? We chopped all over S1 all morning long during pre-market. Oops. Pivot points, they work. Again, because people trade them. That's it. All right, let's see. What else can we mark up on this chart? Let's go to, let me clear this. Get rid of some of this noise. Let's go to a 30-minute chart. Maybe you won't, maybe you're an options trader. Now, you've heard me say a dozen times before, if you don't understand regular price action and the technical analysis stuff that I talked about, I'm not saying we always learn new strategies, new this, new that, and the other kind of thing. But if you don't understand the concepts of what I talked about, if you don't understand the idea of triggering people's stops and all that, things like that, you got no business trading options unless you're going to trade it purely by statistics. All right. There are people like Signet who absolutely can trade options by statistics. Just looking at the options chain. Trust me, he can do it. Drawing on the y-axis. What am I highlighting? A chop zone. Now, you can call it a chop zone. If you are over here in time, Kevin would call it what? A supply zone. He would call it supply. If you're over here, because you see we went up when we rejected, so Kevin would call this a supply. Okay. But what do we know? We know that when price got into here, it choppity, 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 chop. What does that tell us? It means consolidation. It means rest. It means compression. Okay, so what? When price goes into chop and compression, you need to remember one thing follows. Big moves. Because this is compressing the spring. Compressing the spring. And what happens when you take your fingers off the spring? Boing, 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 it shoots out like a rocket. There it is. Right there. Boom, boom. Back in. Brown. Back in or near it anyway. Brown. There it goes. Right? Okay. So we know that this is a highly reactive area. Now, this vertical line here and here represents a day. Maybe you're trading 0-day options. Here's where you would sell your call. Right? You could sell a call there if you were doing that. Again, if you don't understand regular price action, regular technical analysis, you don't go anywhere near options. You do not do it. Options will bleed you dry, death by 1,000 cuts. If you don't understand price action, you will not understand options, and options will tear you a new one. And you can actually, anyway, whatever, I'll shut up. Anyway, let's take a look at this. Let's continue marking up this chart. So we have a chop zone. Here. Here maybe. Here maybe. Kind of like that. Kind of like that. Oh, I kind of missed it, didn't I? Let's see. There. I think. Anyway, here to here. Tag. Reverse. VWAP. Reject. Here. Measured move, I believe. Let's take a look. I'm going to go from this candle here to this candle here. Not quite so much zoom. We went from here to here. Measured move right there. Full measured move. Now, why do I pick these points for the measured move? Let's take a look at that. A lot of people don't understand where to put measured moves. This low took out a bunch of lows. So it's a significant low. It also took out the prior low. Okay. This high took out substantial high. Didn't make a new high, but it is a substantial high that was part of this bear flag. So my measured move is from here to here. You say, well, can you do a measured move from here? Let's see what happens. From here to here. We made 50%. We made 60, right? Pretty much. I mean, a tick or two, but there's your 61.8. A different number, but still a Fibonacci. Remember, these make sense on, there's Fibonacci's within Fibonacci's.
Right, because if you close, it closed above that 6180 level, that means that it could bounce from here, which
Yes.
is what it's doing.
Yes.
If it closed below it, then you could then
Make the
perhaps
full.
say it'll go, yeah, it'll make that
Yeah.
full down move.
Exactly. Now, before I forget, where are the magic turning points? Now, I learned this from Signet. I absolutely learned this from Signet. I did not know this until Signet showed me. And this was just absolutely amazing. The magic turning points is the 111.8 and the 2.36. If it cannot make it past these two, it ain't going. And it'll probably go back into 50% in the midpoint of the range. Pay attention to what I just said. If it cannot clear, you'll usually see it turn. Now, like Signet will take a trade right here with, say, he might go long right here with a stop right here. Now, he would have lost in this particular trade. But you can see this was a pretty, big moving candle. But that's also if he thought this was going to bounce and go back north. So if you can't clear this region here, you are not going to continue on. Now, that's not to say that you won't come back up here, consolidate for a while, and make a second attack run. But as far as this run concerns, you ain't going to have it. I learned that from Signet, and that was pretty amazing. Now, I want to talk about this candle right here. Oh, my gosh, look at this candle. Now, we're on the 30-minute, but it's fractal. Same thing applies. Doesn't matter or not, whether on the 30-minute or the 5-minute. This is what I call a big-ass candle. And this big-ass candle also sets a range. Now, there's two ways you can mark this. One, you can do the entire candle, wick to wick. Look right there. What happened? What is that number? What is that number right there? 23.6. What did we not do? We didn't clear it. We turned. There's a very good chance that we might come right back here to the 50% mark. Very good chance. Now, we've got a trend line here that we've got to clear first. So we might come up this trend line, bounce, and then roll back down. And that would be called a break, retest, bounce. Signet also calls it a Busby. There's a story to that. But we're talking about the closes, not the wicks, necessarily. Now, there's another way to mark the big-ass candle, and that is just the body. So this open to this close. And where do we make? Well, we made between the 50 and the 60 move there. Different people market different ways. It doesn't matter so long as you understand the way that you trade. So long as you understand it and know how to trade based on it, it doesn't matter which way you market. It's up to you. This is where you have to practice and just get into this. But that's what you call the big ass candle, and it sets a range. And we've already seen right here, it near went there to the 61.8, but if I did the full candle, I forgot what it hit. What did it hit? Oh, it hit the 1, 2, 3 and rejected. So, including the wick, it hit the 1, 2, 3, rejected. Perfect lineup, lines up exactly. I did not know that was going to happen, considering I just did the talk on the 111s and the 1, 2, 3s, but there's a perfect example of that. Now, questions about any of this so far? Okay. Where are we? 12:20. All right. RSI. Let's talk about that for a minute. What is RSI? RSI tells you the speed or the velocity of change in a direction. Huh? In other words, this here is a gentle walk down the path. It is bearish. So we see a gentle walk down the path. This is a race to the bottom, and so we see this big race. Okay, what they're telling us is that in this candle, there was a huge race to the bottom. You say, well, obviously you can see that in the chart as well. That's true. That's very true. In that regard, you don't need the RSI. Absolutely not. But what the RSI does tell us is this is called an oversold and an overbought. This is what's called an oscillating indicator. It goes from 0 to 100. Below 30, we say we are oversold, and it's time for the buyers to start stepping in. Above the red line, we say we're overbought, and it's time for the sellers to step in. Well, let's see if there is some correlation to this. Let's just go back a little bit. And, well, you know what? The 30-minute moves too slow. Let's go down to the 5. Or, yeah, the 5. Here. Overbought. So we're saying it's time for the sellers to come in. Well, let's look up here and see what happens. Sellers came in. Now, can you trade based on this? First of all, it can walk this line for quite a while. Notice we hit it right here, and we continue to walk and walk and walk and walk and walk until, now, why did it turn here? Well, we'll have to go look way to the left to find that answer. I'm not going to find it here because this is not a continuous contract. This is the H6, so I don't have enough information on the left to go back and look at this. I'd need TradingView or Thinkorswim to see that. But there's some reason why here was so special. Any rate, but my point being is that it can walk. No, wait a minute. We kind of see here now. We notice it's also walking the red Bollinger Band. So not only is it overbought, it's walking the red Bollinger Band, but that we're talking about RSI here. It continues to walk up, and for whatever, if I looked far enough to the left, I would find a reason for this to turn here. I very likely would find a reason. There would be some liquidity it grabbed here from an earlier part in time, and then it starts going, the sellers start taking over. Well, let's advance to here, where now it's oversold. Well, here also happened to be market open on this day. Whatever is that today? I'm not sure. Anyway, it went down. No, this is not today. No, this is yesterday. Whatever, last day. Well, anyway, it went down, oversold, and it says we're now looking for an opportunity to go north. But just because it comes down here doesn't mean that, well, obviously we go long now because the RSI, well, remember I showed you back here? What did I show you back here? I showed you how it just kept walking up and up and up and up and up and up and up until it reached a reason to change. You don't want to go short here. You're stopped out. So this is just something that says, heads up, we may be looking for an opportunity to change direction here. Now, it doesn't necessarily, it's not a signal. It's something to be aware of. In this case, pivot point maybe. Okay, that works. It was outside of the Bollinger Bands. It was oversold. You could say go long here because of outside of the Bollinger Bands, and we expect price to stay within the Bollinger Bands. Maybe that's your rationale. Maybe it's because it hit this pivot point. Maybe it's a combination. And where did we go? Well, we went to the other side of the Bollinger Bands, and these numbers up here took out highs, previous highs. This is also going to be hard to see. I'm going to move my mouse there because the color is so. This high volatility level, 6940, is a Menthor Q level. It's one of those spot gamma Menthor Q level things. Do you need it? No. No, there's usually some other reason. If I put a line on this chart right here, and I go back and look left following that yellow line, I'm going to find out that, well, obviously we took all of this out. Let's see if there's anything else. Yeah. So when we came out of that zone, we stayed down here. You got all these people that went short down here, and this was a couple days actually ago. But at any rate, they've been sitting down here. And so that run took these people out, possibly. Definitely took this group of people out. So took those people out. There's your contracts. They need to go short, and down they go. So it did give us a heads up that something was on the books to change, but it doesn't tell you how long, when it's going to happen, how long it'll go. As you can see here, remember I'm on the 5-minute chart, so this was just a quickie. Up and down. Here we are below again. Up and down. All right. Total of maybe 20 minutes there, it looks like. So, but it, it is an indicator that can maybe take a look at some of that kind of stuff. Hood. Renata, let's see. I can't do Hood over here. I'm going to have to do it on Thinkorswim. Give me a second. I don't have stocks on my Tradeovate account. Let's take a look at that. All right. First of all, let me come here. You remove that. My Thinkorswim just drags so bad. It used to be, I had it tuned really well, and it just, okay. I'm on the daily. Let's start marking it up. Suppose I could do it in TradingView, but I'm here. Here's our highest high. Come here. Come here, you stupid thing. There. There, or do I like here? I like that better. Mainly because of these three candles right here. Let me zoom in that. Yeah, I could have taken this one here, but see how these three candles here kind of reacted with it a little better? So I like that one. I like that line a little bit better. Let's see if we can do a derived line. Now a derived line is going to be, wake up you stupid thing. I'm going to look right here first, and I'm looking to see how much interaction there is with this line. We do have a, what am I looking for here? Here, we got a bounce, we got a below, we got an up. It's chopping on this line. I'm going to keep that. And in fact, since this is my derived line, I'm going to move it to dot to tell me that it's a chop line more than it is a to the tick line or whatever. There's our trend. It's down. We're looking at our Bollinger Bands here on the daily, and we look at our RSI. What do you see in this RSI?
That it's losing momentum.
Yes. There you go. You said, wait a minute, you just put a trend line on an indicator. Sure. Why not? Why not? Now, that doesn't always work. But now, at the same time as putting a trend line on it, another thing I want to do, though, is, since we're talking about momentum here on this RSI, actually, I also want to look horizontally on it. We are, I'm going to put, where is the bulk of the action on this trend line, on this indicator? Is it right here? Look right. We see a lot of crossover, don't we?
I see yeah, and actually it went lower.
So that tells us that's kind of a sweet spot for the RSI. It likes that area. What is that going to tell me? Well, since it's below 50, it means a slow grind down. It's below 50, so that means it's kind of grinding down, but slowly. There's another way to look at it.
Because the way I see it and you might be right. The way I see it right now is it looks like a trampoline move, a trampoline.
I've heard you use that. I don't know what you mean by that.
But it goes lower, like it pulls back to a lower low, and then the next thing you know, then it just jumps, it pops from there. It goes
Okay.
higher,
So it
and
sounds like a liquidity grab. Like, in other
yeah,
words, it drops below this candle right here. It comes boom, and
it's
then it goes way up.
yeah,
Mm-hmm.
in the CT whatever language is,
Mm-hmm.
it goes all the way down, sweeps all the liquidity out, makes a lot of people get
Stop
out of their
out. Mm-hmm.
trades,
Mm-hmm.
and then it turns around and then it just rockets from there, never stops.
Okay. Yeah, sure. Why not? Maybe we're talking about the same thing, just you've got a different terminology for it. You know, I talk about trend lines. Jeremy calls it angular resistance or angular support. Same line. He's just got a different vernacular for it than I do. And that's fine. It took me a while to realize that's what he was doing. But
But I also like to combine it with what you were talking about, is that RSI. I mean, I like that, to be able to put a
mm-hmm,
trend line on there and see just how it's reacting, so that I can build some confluence with what I'm
sure.
interpreting as a trampoline move.
All right. So let's walk through this chart from left to right. Actually, I'm going to start right here at this highest high. What did we have? Now, one of the things I'm looking for are patterns. First of all, does it stay between the Bollinger Bands? Pretty much. Pretty much. it hits these lower Bollinger Bands, it does have a tendency to mean revert if you like Bollinger Bands. Not saying that's the truth, gospel, or anything, just pointing that out if you like Bollinger Bands. Number one, so we've got a high here, we've got a low here, we had a high, we had a low, we had a move back above 50%. Here's the 50% line over here. Move back above 50% and a rollover. So there's an ICT setup. I don't. There's maybe a tiny little fair value gap there on the daily, but I definitely would imagine there's one on the hourly. So there it is. Also notice trend line. It came back up. So you've got a combination of ICT plus trend line. If you do ICT, doesn't matter. You don't have to do the ICT. You can see it in the trend line right there. Bang. Came down. Where did it go to? 50% measured move is right here. Also happens to be the bottom of the Bollinger Bands. What do you know about that too? Again, confluence. Where did it go to after that? Midpoint. So it did not complete the measured move, the full measured move 100%. But it did hit. So one thing to note, we have a higher probability of hitting the 50% than any. If we can make it through the 111 and the 123, very good odds of hitting 50%. And we have to clear the 618 if we're going to make 100, which we did not. So we moved back to the midpoint of the range. And so, okay. So there was from here to here. All right. Now, and we've got another measured move. Huh?
No, I was going to point out that I'm looking at the fibs on the lower time frame, the 15-minute, and it gets up to the 100. It completes the move up at 100, and then now that at the 100 level, it's starting to pull back. That's the resistance level.
Okay.
It may not hold. It
Right.
may be,
Okay.
but yeah.
Sure. Now we've got another setup here. Right here. I've got a fib within a fib. And here, let's kind of zoom in on that a little bit so you guys can see. Oops, that's not what I meant to do. I meant to do that. I marked to this low, to this most recent high. Why this? You say, well, it didn't take out this high, but it is a high that took out a lot of highs before it. And this low took out a bunch of lows before it. You can see it's a pullback. Now we're still inside the box. So we're still inside the box, so there's no breakout yet. We have a measured move, but there's yet another measured move in here. I don't know if you guys see it or not. Let's see. And that is from here to here. Come on, lock in. There you go. There to there. Now you can see we stuck a toe out. What happened? Right there. At the 111. Went right to it, and it's rejecting. Now, the candle's not closed, but as you can see, we tried to make a break for it. Didn't happen. If we go back into this box, we're probably going back for the midpoint of the deviation range, which will put us back here at, what is that? Right smack over my... Get over here. It'll probably put us back here at 120. They may go for this high right here. We'll just call it 125. They may come back for that high at 125. And that is because there is a clear fair value gap right here from here to here. So the top of that one fair value gap, 125.8. So I would not be surprised if it comes back up to at least 125.8. But at the same time, what do we see happen here with this Bollinger Band is it came back up to the middle of the range, bounced, went down, stuck a toe out. It could come back up and make a second run. You say, well, should I go long here? I would next, if I was interested in going long on Hood, then I would say let's drop down to the hourly and let's see what's going on within the hourly time zone and analyze it. Notice the trend is reasonably flat. Reasonably flat. And because the trend, now, by the way, remember this is a 20 period simple moving average. Maybe you like moving averages. Matter of fact, we can take a look at that. Come on. Stupid thing. I've done it. It used to be, I swear, before Schwab, when TD Ameritrade had this, Thinkorswim was just great. Ever since Schwab took it over, it's been garbage. I still do my long-term holdings on it but whatever. I'll shut up. What was like, oh yeah, we're going to do moving averages. Edit studies. Let's turn off the Bollinger Bands. Let's turn off the sequence counters. And let's turn on, I've got one that's already built. One good thing about Thinkorswim, man, you can write scripts on this thing. Okay. Let's zoom in on that. And let's get this out of the way. I can't stand clutter. All right. Red is the 3 simple. Green, the 10. Blue, the 21. Those are my most important ones. Yellow, I believe, is the 50. Let me double check that. I don't do the moving averages that much.
I call it the 3A trap, where you're looking at the 3 EMA and the 8 EMA, and right now the 8 is above the 3. So if
you can do that.
Price action. Mm-hmm.
I use the 3, the 10, because Signet likes to talk about the 3 and the 10 surge cross. I don't normally use moving averages that much because of all this crisscross kind of stuff. It is a way to trade, no question. It's definitely a way to trade. We're going to have to look at the 50 because that is our simplest one right now, and then we'll look at the 21. Some people use the 20. The 21 has significance because it is found in 2 places. Number 1 is the Fibonacci number, and number 2, there's 21 days in a trading month on average.
Also, what you pointed out earlier, which I still find it interesting, the RSI now is pointing up. So
Sure, but also notice up and then down and then up. So short-term RSI is, I fell into this trap myself of looking, let's say, just at that line and say, okay, let's go bullish. So we kind of want to look at the trend, and I want to see where I am on the 50 line. I want to see where I am on the 50 line.
yeah, I'd like to see it approach that 50 line and go above it.
So let's, let's, give me, there. Now, edit and put it on the 50. So we're below the 50 on the RSI. Notice that when we went above the 50, we held it for a little while, but the bulk of our most recent time has been below it. We were overbought here, came back to the 50, tried to make another run of it, failed, make another run of it. Notice this high of the RSI is lower than this one's. Let me line up that again. Look left, you'll see it's lower. They didn't have the momentum, and that's clearly visible here in the chart. So again, the chart tells you just as much as you need as well. as this RSI. The RSI is mostly for this overbought, oversold business. All right, let's do some markup on this. I think we did this already, didn't I? Yeah, because I said I liked this better. And then we do our derived, maybe down here. If I put it here and I look left, I see it where it chopped all over it over here. So that's a good place for it, possibly. Let's look at some other places. What if I target it on this candle here? Do I see a lot of reaction? Down, reject, down, reject. That's a good candidate also. And in fact, I could put 3 on here. Let's change you.
It looks like it's rejecting higher and higher still.
Come on. Now I'm going to duplicate. Okay. There we actually have multiple trends. Based on this low here, I go back on the left, I see it chopped over here. Based on this low, I can see a lot of chop on it right here, 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 here. Remember, these are derived here, so these are areas where this is supposed to be a little bit more to the tick. Okay, so there's your trend lines. Definitely bearish at the moment. Now, what else do we see? Let's zoom in. We see this low right here, a significant low. Low, bounce. We see that we took it out. We see that we rejected it. So right now it looks like a liquidity run.
And resistance, it's bouncing off of support.
So could it be ready to go back up to the 50? Possibly, because one of the patterns that we will see is it hits the 21, tries a new low, then it hits the 50, tries a new low, hits the trend. You know, a lot of times we'll see that it will bounce on a, make a tiny little high, go down, then make a higher high. Because if you look at the way it's moving through the trend, bottom of the trend, top of the trend, middle of this bigger trend, chopping around, hitting that trend again, very possible, as we're seeing right now, what we've got here is a hammer. Not quite a hammer, because a hammer would be green instead of red, but at this point, it's definitely looking like it may flip. Now, if it does, you could take this long. I would target, you've got this fair value gap right here. You could target the 21 with your stop right down below this candle. If it breaks this low, you need to be out of this trade. But so you say, well, does that give me a good risk to reward? Not really. It's closer to a 1-to-1. It's not a 2-to-1, but depends on your risk tolerance. As far as how long it should take to trade that, well, 1, 2, 3, 4, 5, 6, 7, 8, a week, 2 weeks on the daily. Now, if you are an options trader, certainly you could take whatever that number is, call right there. Let me see if I can find, yeah. You could take the 123 call, or you could take the at the money call. You'll make more money at the 114 call if it works out, but you're putting more money on the line. That if you're wrong, you'll lose more money. So, okay. Now let's look at the moving averages themselves, though. The 50 is bearish. Always be careful when you're trading against the trend. Always be careful when you're trading against the trend, because trading against the trend, you should be doing scalps, not longer plays. This is slightly bearish, kind of flat, clearly bearish. You're trading against the trend. The odds of a successful trade here are not in our favor. Could it go back up here? Yes, but what do we have here? We have a pole. We have a bear flag. Boy, we have nothing but bear flags today. Nothing but bear flags today. Golly. Let's mark that out and see where it goes. And
Yeah, you're right. I got two. I didn't take the trade, but um, as long as it's trading under that 50, it's not long. You're not long.
now,
You want to get closer
right.
to the 50.
I mean, you can take it for a scalp. I can easily see it getting back to the 10. It could probably get back to the 10. But do I see it getting back to the 21 or the 50? You're going against the trend here. You say, well, should I go short? No. No, why not? It's not an entry point. This is not an entry point. We went down, we tagged whatever this is, probably the 1, 2, 3, and maybe the 1, 2, the 2, 3, 6 here. We rejected. No. If you want to go short, you want to wait until you take out these highs right here at minimum, ideally coming back up to here and then going short. Because in that situation, your stop is much more tighter up above the 50.
A kiss goodbye at the 50. Okay.
So that's, now there's another way we'll look at this too. Something else. Now I'm going to put on some volume profiles. Actually, I'm going to move this off. Let me move that off the screen completely. Let's put on I already know what it's going to say, but I want to illustrate some stuff. Volume profile. And for this volume profile, I'm going to put it on the weekly. Now that's going to drop a series of yellow lines in here. And this is very, very, let me turn that off. Turn off all the blue stuff. That just makes so much confusion. Come on. Okay. There. All right. Chart's getting noisy. Wrong key. There we are. Lines. Here's the weekly volume profile right now. Right here. Here's the prior week, that yellow line right there. Right there-ish. And here's the week before that. Now, let's open this up. All right, this is busy with all these lines on here. However, this is the current current volume profile line here. We do have two volume profile lines fairly close to one another from the previous couple weeks right there. What does that tell us? Well, that was a place where people really liked that price. People really liked that price at that time. So if we were to go bullish, this is most likely in this range where we are going. If, on the other hand, we're going bearish, then wait a minute. I've got something wrong here. That's not. It's this line, and it's this line. I made a mistake there. Here. So here's our bearish downside that we really like in the last couple weeks. Here's our bullish side that we liked in the last couple weeks of these two lines up here. So if we're headed north, we're headed back. So remember, volume profile is like the grocery store. If you go in and your pack of cookies is $2.36 and you like that price, when it's $2.36, there's a higher chance you're going to buy it. But if it's $4, you'll say that's too much. So now if it's 50 cents, you buy too much of it and you set this lower price down here. But at some point, the manufacturers say, we can't sell these cookies for 50 cents because we're losing money. And they start raising the price. But when it's $2.36, you're willing to buy it. And that's the idea of auction market theory. The price that people are willing to pay is right here, this sweet spot, around $119 to $120. So if we go bullish, this is the area we're most likely to go. The more recent carries more weight than the old, so that puts us around 120 if we go bullish. But again, all our indicators from our moving averages are bearish, so you got to have a really high conviction reason to think we're going bullish here. I don't see it just in the candles, except for the fact that we have taken liquidity. We've hit a trend line, but just because we've hit this trend line doesn't mean we don't come back and continue walking it. So, no, I don't see an entry here. If you do decide to go bullish, go small. Your stop is right below this candle here. Small size, that if you get stopped out, you're not going to cry about it. It was a gamble. It's a one-for-one trade. So.
Makes sense. Thank you.
Mm-hmm.
This is good. Thank you.
Okay. All right, we're coming up on 2 hours here, so I'm going to start wrapping this up. Has anybody got any questions? Anything you want me to look at? Any studies or trading styles or anything like that we want to go over? Okay, I'm going to remove all the... Be still, you stupid thing. We'll get rid of all that. Double click over here. So we've got some lines and all that kind of stuff. All right. Let's see. Last thing we'll talk about, broadening formations. This is longer term kind of stuff, but it depends on the time frame you're on. But let's look at broadening formations. Here's a significant low. Here's a significant low. This is also known as a megaphone there. Here is a high, and here is a high. That is showing us a broadening formation for which trading can go. Now, I want you to watch carefully what I'm getting ready to do. People have asked about Jeremy's fan lines. I took this high here, and I took this low here. Note this 50% line. Here at the apex. At about the middle between that high and that low, or, well, no, wait, excuse me, that's not right. I'm looking for it's over here. Is the 50% line. Between here and here's the 7,500, actually, excuse me. Wrong. Try that again. And the 0. Now these are fan lines. So now let me get rid of this because it's really... There are Jeremy's fan lines. Look. There. Now, the good and the bad to fan lines, I know we've had people asking about fan lines. There it is. The good and the bad to fan lines is that they give you price targets, but they don't necessarily tell you what it's going to do when it gets there. In other words, here we see we're moving up, we started, and we moved up. We did not hit this and roll over. It just means it interacted with that line. Here, we came down. We didn't necessarily stop here. We came down to here. We did pull back. We did open the next day on the fan line, and we moved down a fan line. But this tells you where we expect things to be. Actually, they're not quite perfect. They're supposed to be in quarters. 1, 2, 3. They're supposed to be in quarters. I don't have them quite right. But that is what fan lines are. And strangely enough, they work. Matter of fact, go backwards in time. There. 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 Look at that. Isn't that amazing? Because this is all another modification of trend lines, and it's all mathematical algorithmic trading. Right? And like I said, I don't have, some of my lines are not quite right, but still the point is that there it is, fan lines. And the frickin' things work. Now, again, it's another type of trading strategy that you have to learn to trade it. You have to learn how to trade it. You can further extend this. See if I can do this right. And go outside the bounds here to this 50, and right there it is. Right there it is, right there. See it? And I can go here to this 100. Not as dramatic. Not as dramatic, but anyway, you get the idea. They work in reverse. Anyway, okay. Doesn't that blow your mind? You draw this based on what you see now. Go back and look at the in past, and you see that the daggone trend lines work in the past. So, that is another trading strategy. That's Jeremy's fan lines. So all strategies work sometimes, but no strategy works all the time. It's in the context. And the context is looking at the bigger picture and saying, does it make sense that this strategy should work at this moment in time? And then you have to decide an extra yes or no. Not easy as yes or no, you're right. The fan lines are definitely more complicated. But some people, like Jeremy, specializes in them, and he does really well with them. But, you know, you have to specialize in it. You really want to find something to specialize in? I got to wrap this up. I'll show you something to specialize in. This will blow your freaking mind. Ichimoku. Do I have all the studies turned on? Let me look. Reset to factory. Ichimoku is a series of clouds and moving averages, and the idea is that it will project into the future where price will go, and you're supposed to take trades based on these moving. All it is they've taken some of these moving averages and moved them forward in time. And they draw clouds based on those moving averages, and the idea, now this is what you call spaghetti head syndrome right here, to try and make sense out of this thing. To try and make sense out of this thing will give you a headache so fast. But I know people that trade this. You can go on YouTube and you can find that people that trade Ichimoku. I can't make any sense out of it. I tried to learn it. I made an absolute effort to learn how to trade this. I could not make any sense out of it. None. But again, there are people that specialize in it. Essentially, though, this is telling you that everything's bearish. And when it left this cloud here, it moved bearish, and the future is bearish. That's basically what it says. If we go back in time, it left the bearish sentiment here, and when this turned and the future showed bullish, that's when you would have gotten in. And in this case, it worked. Right? Until it didn't. Right? Now, it's still bullish from way back here, but it did pull all the way. But then they would say, well, you're on the wrong side of the cloud. You're supposed to be out of this. And so you would have, when it went back into the cloud, you would have gotten out of the trade, and you would still be out of the trade because now it's telling you the future's bearish. I say it's crazy. Absolutely crazy, nuts kind of stuff, but there are people that specialize in it. You know, okay. So you hear me joke about Ichimoku all the time? This is why. All right, wrapping it up. Any questions from anybody before we close it down? All right. I hope you've got something out of this. We've talked about a lot of different strategies, a lot of different concepts, trend lines, fair value gaps, ICTs, Ichimoku. all kinds of crazy different stuff. And none of these strategies are better than any other strategy. It's the one that makes sense to you. Because Jeremy can trade fan lines, but a lot of people cannot do it. That's fine. That's fine. That just means that strategy is not for you. Maybe you like combining RSI and something else. Maybe you like Heikin-Ashis. I'll show you a quick Heikin-Ashi study that is really can. Let's see. RSI. Here's one that I use. People ask me, what do you trade? Bollinger Bands, RSI, and come on, update, and Heikins. What the hell is that? Heikin-Ashi is not a true candle. It is derived from yesterday's candle. The opening of today's candle is the average of the high-low close of yesterday's candle, so it's not true price. What it does, however, show you are reversals right here. Dojis and spinning tops. There. This one failed. Well, I mean, it didn't fail because you didn't go short here because it never went short. But here. All right. Didn't last, but so, we trade it then with the longer term trend. So here we are, kind of flat. We start trending. Here we have a pullback, doji, spinning top, go long at the break of this doji, ride it up, and, moving your stop up as you go. That's one way you can trade. Does it work every time? Absolutely not. Here's a perfect example of a failed trade. Here's your reversal signal, but you would go short here, which never triggered. Let's find a fail. Here's your reversal candle. Usually we're actually looking for the opposite color reversal. I'm looking for a red here, but we don't see it. We took it short, went back, failed. All right. Heikin-Ashi is also really good for showing you chop. When you have wicks on tops and bottoms, that's chop. A good solid trend is when you only have wicks in the direction you're moving. For example, only upper wick, only upper wick, only upper, pull back, upper. Now we have a double wick, possible trend change. Well, okay, looks strong, but here we go, double wick. Now, only lowers. Strong trend down. So there's a little bit of a learning curve to Heikin-Ashis as well. But again, it's another way to trade. Combine that, let's say, with Bollinger Bands right here. I see it's hit the Bollinger Band. I'm looking for reversion possibly, but I also know I'm trading against the upward direction, so probably wouldn't. But here we are. We're kind of bullish, slightly horizontal. Hit the lower band. Here's my reversal candles. I might have been stopped out originally. Then I might have gotten back in and rode this all the way up. Here you can combine it with RSI if you want to, looking for some pullback up to confirm a bias of a pullback. Have I got any greens here? Not quite. You can see it's not quite in the oversold. We hit the Bollinger Band. I look for the reverse. I'm seeing some reversal candles. I go long here, ride it towards this other one, but which stalls. It didn't make it to the midpoint kind of idea. Over here we can see, though the entry is hard over here because this looks like an entry, but it fails. No, it didn't fail. because the entry would have been down here. So no trade, no trade, trade here, fail. Trade short here, coming out also confirmed by RSI overbought, and write it back down to the Bollinger Band. So that's using multiple indicators and strategies to form a narrative on a trade. So yet another trading strategy. So that's one of the plays that I like. I do keep a normal chart up though, because for intraday trading, because I'm looking for liquidity runs. This high is an actual high. That's a true high, and that's a true low. But what happens in the middle does not match up with regular candles. So, at any rate. All right. I need to shut down. It's been 2 hours, and that's enough yabbering and babbling and all that kind of stuff. So, hope you got something out of that. We can do this again. Some more chart markup kind of stuff. Always happy to do that and show stuff. Again, you're looking for the trading strategy that makes sense to you. You got to look at a bunch of them to find the one that makes sense. It's like shopping for a car. You go out, you test drive a bunch of cars, and then you find, I like this car. This is my winter up car or whatever. But the point being is that when you go out and look for cars, you learn a lot about all different kinds of models of cars. The Chevrolet is this, the Nissan has that. You learn a lot about different cars, but you only pick the one that you like the best. And trading's the same way. Learn a lot about all kinds of different strategies, but you're going to pick and trade the one that you like, that makes the most sense to you. So with that, I'm signing off. This is Marziti here with the Bullish Bears. And if you're on the outside looking in here to our thing here, let me point out where is it here? The Bullish Bears, bullishbears.com has, just for those of you that are already members, this is just going over stuff you already know. But if you are not a member of the Bullish Bears, understand I am not a moderator. I'm not paid. I'm a member just like everybody else. In my case, I just enjoy helping and training and running my mouth and all that kind of stuff. The Bullish Bears is unique in that we're small enough that people can talk back and forth, even with the moderators. Even on open mics, we teach price action, because price action is the foundation for anything else, whether it's options or anything else. Price action is price action. You got to learn that, and then the charts will make sense to you. We have all kinds of courses, kind of stuff. We have a Discord where we have daily live trading and all that kind of stuff. Feel free to please come check us out, bullishbears.com. And with that, Marziti signing out. Be good, or at least be good at it. Bye.